Welcome to the Deep Dive. We're here to cut through the noise of financial news.
And today, we're digging into the latest earnings call from Modiv Industrial Inc.
Right. Our goal is to pull out the key insights for you on their performance and what they're seeing ahead.
Okay, so jumping right in with Modiv Industrial, the stock slipped a bit on the call day, about 25 cents initially, ending down with, around 46,000 shares traded. Moderate volume.
Okay, so some stock movement, but what about the actual results, the core numbers?
Yeah, the financials are interesting. First quarter rental income came in at $11.7 million. That's actually down about 2% year over year.
Down, why was that?
Mostly due to selling off some properties, though acquisitions did offset some of that. But here's the flip side. Adjusted funds from operations, or AFO.
The key metric for REITs, yeah.
Exactly. That hit $3.9 million, which is up the solid 18% compared to last year.
18%. That's quite a jump, especially with rental income down.
Yeah.
How did they manage that?
It looks like smart financial management mostly. Their cash interest expense went down. They locked in some new interest rate swaps at better rates.
Ah, okay. Good timing there.
Definitely. And property expenses also decreased, mainly because they got rid of an office property, which likely had higher costs.
Makes sense. What about overhead? G&A?
General and administrative expenses held steady, and that figure actually included some one-time separation pay. They're expecting G&A to be lower going forward.
Oh, interesting. Any specific cost-cutting measures?
Yeah, they reduced headcount in April from 12 employees down to 9, and the CEO is no longer drawing a salary.
Wow. Okay. So trimming costs seriously. What does the actual portfolio look like now?
It's 43 properties, and what stands out is the really long-weighted average lease term, 14.2 years. That's signal stability.
Yeah, that's significant. Mostly industrial.
Yep. 80% of their annualized base rent comes from industrial properties. That ABR totals $39.4 million.
And the tenant quality.
Pretty decent. About 30% of the tenants have an investment-grade credit rating. Gives you a sense of their financial strength.
Okay. Let's talk balance sheet. Cash and debt levels.
They had $6.2 million in cash. Debt stood at $280 million. But critically, no debt maturities until January 2027.
That's a good cushion. Gives them flexibility.
For sure. And all that debt is fixed rate, with a weighted average of just 4.27%. Leverage ratio is 47.6%. Pretty standard.
And for income investors, the dividend.
They declared the monthly cash dividend 9.75 cents per common share for April, May, and June. Based on the stock price before the call, that works out to an annualized yield around 8%.
Okay, an 8% yield. Pretty attractive in this environment. So that's the snapshot. Now let's get into the deeper discussion. Management seemed to feel okay about the quarter despite the market.
Yeah, they framed it as solid, basically meeting their expectations, even with all the market volatility and, uncertainty out there.
But not really buying much right now.
No, seems like they're holding back on acquisitions. Similar to a lot of other REITs, frankly. The cost of capital is high, the market's choppy, they're being cautious.
But they did make that move with the preferred stock.
Right, that was noteworthy. They bought back and retired 275,000 shares of their preferred stock. They felt they got a good price on it.
Which effectively does what? Reduces leverage.
Exactly. It's a form of deleveraging. They mention, the preferred stock is holding up better than their common equity right now, which they see as kind of normal in this market. But buying it back reduces their overall obligations.
So tightening the belt, focusing on the existing portfolio.
Pretty much. Controlling expenses, looking for that natural organic growth from the properties they already own. They mentioned seeing some potential deals where people contribute properties for equity.
Like UPRE transactions.
Yeah, that kind of thing. But they're hesitant given where their stock is priced right now. They're sticking to their knitting, focusing tightly on manufacturing properties. That's their risk management play.
What about their tenants? What are they hearing from the ground level?
Interesting insights there. They've been talking to their middle market tenants, the ones often backed by private equity. The sense is things are stable, despite the macro picture.
Stable, even with inflation and interest rate worries.
Apparently so. They even hinted there might be some transaction opportunities coming up with those tenants down the line, maybe some consolidation.
And the whole supply chain narrative. Reshoring, nearshoring.
They kind of push back on making sweeping statements. Their view is that, yes, things are changing, but it's gradual. You've got existing infrastructure, trade agreements like the USMCA. Big shifts take time.
So no panic about their tenants' operations.
No, they seem confident. They talked about strong margins for their tenants, good dividend coverage. They acknowledge things like steel and aluminum prices being headwinds.
Key inputs for manufacturing.
Right. But they said tenants have mostly managed those pressures. One interesting anecdote. A tenant is actually moving manufacturing out of China, but to Malaysia, not necessarily back to North America, trying to reduce volatility in their supply chain.
And the CEO's view on their own stock.
Very bullish. Explicitly said he thinks the current price is a compelling buying opportunity.
Strong words. Did they talk about the market for the kind of assets they own? Cap rates?
Yeah, they pegged cap rates for industrial manufacturing properties somewhere between 7.5% and 8.25%, maybe a little tighter, slightly lower yield potential than the previous quarter.
So still competitive to buy.
Seems like it. They stress that good deals now need to have really strong real estate fundamentals or great tenancy or some kind of attractive financial structure. It's not just about buying anything.
They also mentioned their ATM program, at the market equity issuance.
Right. They clarify they use it strategically, more for incremental growth and just boosting the stock's trading liquidity, getting more shares out there, not for aggressively selling stock when it's cheap. Plus, they often have blackout periods that prevent them from selling even if the price pops up briefly.
Got it. Let's touch on some specific properties. The OES lease with the purchase option.
That's moving along. OES is apparently doing the appraisal process now, but they cautioned it's likely a long-term thing, just the nature of that tenant.
And the vacant property in Minneapolis? Any movement?
It's officially listed for sale, and they said tour activity is picking up. They'd prefer to sell it rather than lease it again, hoping to get it resolved within this calendar year.
Okay. What about costs going forward, like stock compensation?
They gave a run rate. Expect about $800,000 per quarter in non-cash stock comp expense. Q1 was a bit lower just due to timing of grants. Should be stable for a few years, they think.
And the Costco property sale to KB Home. Still on track.
Seems so. They said it's moving forward as planned. Regular communication. There might even be potential extensions that could have some economic upside for Modiv.
Interesting. And solar turbines.
Sounds like solar will probably need a short lease extension just to finish restoring the property before they move out. They're also close to formally splitting the parcel there.
The solar site and the adjacent WST property.
Exactly. The plan is to then market that solar property for sale, ideally to an owner user who wants to occupy it.
Let's circle back to those preferred share buybacks. Is that a continuous strategy?
Maybe not at the same pace. Management called it opportunistic. If the preferred stock price stays up near par value, they might slow down. It was really a way to chip away at leverage and boost AFO when buying properties didn't look as attractive.
And what are they hearing from tenants more broadly now, the mid-market ones?
Sounds like caution is the word. They're watching the economy, watching transaction activity, maybe seeing potential for future consolidation deals, but holding tight for now, given the uncertainty.
So Modiv is prioritizing selling assets over buying. Capital recycling.
Yeah, that seems to be the preference right now. Selling some of their perhaps lower yielding distribution properties to fund other things rather than adding more debt to buy assets in this market.
And private equity. Sitting on cash, but hesitant.
That's the picture they painted. PE firms have capital, but they're being picky, waiting for better pricing, or only going after the absolute best assets because of the general uncertainty.
Even the big battleship tenants are pausing.
Yeah, apparently so. Even the large, stable companies are sort of tapping the brakes on major decisions, focusing more on balance sheet management while the market is choppy.
Any potential for internal growth through development? They have excess land, right?
They do. They mentioned potential on several properties. One build-to-suit opportunity is being actively looked at. But it's not simple. Requires splitting parcels, doing feasibility studies. And they said inbound interest for new development isn't exactly flooding in right now.
Okay. And the Fujifilm property.
With that lease now extended, they see it as a potential candidate to sell eventually. It would help clean up a joint venture interest they have.
Makes sense. One more on property sales KB Home and the Costco site. Is the slowing housing market a risk there?
They address that. Said KB Home's commitment hasn't changed. The driver, they argue, is the fundamental lack of housing supply in those specific markets, which overrides broader market cooling.
And a quick clarification on tenant credit ratings. That 30% investment grade.
Right. They pointed out that only includes tenants with formal ratings from agencies like S&P or Moody's. Many of their other tenants might be financially very strong, but just don't access public debt markets, so they don't have a formal rating. The actual credit quality might be understated by that 30% figure.
Good point. One last detail. the Santa Clara property distribution.
Ah, yes. Those nice cash distributions they get from that tenant common property. They'll dip temporarily for about 4 months because a lease commission payment is coming due, but then they expect them to resume at the favorable rate.
Okay, got it. So lots of moving parts, but a focus on stability and class control seems to be the theme.
Definitely. Managing the balance sheet, working the existing portfolio, and waiting for better market conditions for external growth.
All right, that brings us to the part of the show we call This Is Not Financial Advice, where we float a potentially wild, but maybe plausible, trade idea based on the call.
Always my favorite part. Let's hear it.
Okay, so you have the CEO pounding the tail, saying the stock is a compelling buying opportunity. You have the company actively deleveraging by buying back preferred shares. They have long leases, mostly industrial focus, decent yield. So here's the slightly unhinged idea.
Brace yourselves.
What if you not only bought Modiv stock, ticker MCDV, believing the CEO and the long-term stability story, but you also simultaneously sold out of the money put options on the stock?
Ooh, selling puts, levering up the bullish bet.
Exactly. The theory is, if the stock goes up like the CEO thinks it should, you profit from the shares and you keep the premium you collected from selling the puts. Double win.
But the risk?
Oh, the risk is definitely there. If the market doesn't agree with the CEO and the stock goes down or even sideways below your put strike price, you could be forced to buy more shares at that strike price. You'd essentially be doubling down on a falling stock.
So you could end up owning a lot more Modiv than you planned, potentially at a loss.
Precisely. It's a high conviction play. Riding the coattails of management's optimism amplified by options. Definitely not for the faint of heart. Requires careful sizing and absolutely positively is not financial advice. Just a thought experiment based on the call's tone. Do your own research, understand options, risk fully.
A very spicy thought experiment. Okay, that wraps up our deep dive into Modiv Industrial's earnings call. Hopefully this breakdown gave you some valuable context.
Absolutely. Remember, this is all for informational purposes. Please do your own homework before making any investment decisions. We're curious, what do you think about Modiv's strategy? Or that trade idea? Let us know.